Hello, everyone. My name is Tjosaas, and I'm the Minnesota State Farm Business Management Database Leader, as well as a Farm Business Management Instructor at Northland Community and Technical College based out of Moorhead. And I'd like to summarize some of the findings that we had in our state executive summary for the 2021 crop and livestock enterprise year for the Minnesota State Farm Business Management programs. This year, we had 2,293 farms that submitted data that was cleaned and edited by instructors and state leads to develop these reports. So just a quick summary on our front page on our executive summary. So average money spent, these are the average of all of those 2,293 farms spent a little over $1 million. And here you can see the categories in which they spent those dollars. Most of that goes to spending in their local communities. This comes from 7 different colleges in the Minnesota state system. And you can see in this next chart that we show and graphic, we show where all of the farms that have submitted at least one analysis for the 2021 farm year are located. One of the biggest highlights this year was that we saw a dramatic increase in net farm income for our state. Primarily reasons, again, we saw primarily higher prices for crops sold for the 2021 year, crops that were held in inventory from 2020 into 2021, and there was some government payments that were received in 2021. A lot of that was for the previous year's crops. But we did have a lot of areas that were affected by drought. So you can see yield numbers were significantly lower as you look at the individual reports, and some of our crop and our dairy data will show some of that as well. But working capital, so the difference between current assets minus current liabilities, was increased by over $200,000 on average, while a lot of the other ratios increased to a pretty sizable number, a healthy number for the majority of the farms in Minnesota. I do want to highlight kind of what net farm income is for, because obviously a lot of people think that's the total profit on the farm, and really that's the profit before then we have principal payments on the farm, we have family living expenses, we have taxes, we have investments into retirement accounts. So you can see that realistically in the last 4 years, only in 2020 and 2021 did we actually show a positive balance. There actually was money left over to really reinvest back into the farm. If we look on our page 2 here, you can notice that our revenue categories of part of net farm income on crop sales, inventory change, crop income, livestock sales, livestock are all increases from the previous year. You do see that we actually did see a significant reduction in government payments. Where we did see as we saw payments that were happening that were really kind of based on the 2021 crop, and in some cases even the 2019 crop that were coming in there on the crop side. We did have some government DMC payments, margin control for the dairy that did boost some of the livestock payments on that government payment side. Then you can see our cash expenses were up. Net farm income from operations, the only difference between that, so we take our total revenue minus our total expenses, we adjust for inventory, we adjust our depreciation costs of the usage of equipment for a year, and then we have our changes in interest, accrual adjustment changes, then we have our net farm income from operations, and then we end up with a gain or loss on any capital sales that they have of any inventory, livestock, things like that. And then you have that gives our net farm income, and we can see that dramatic increase over the last 2 years. But you can also see that, a lot of that revenue is coming from, we saw an increase in livestock revenue, we saw an increase and actually decrease in other income. So that's where would be those crop insurance or government payments, and an increase in the crop income side. On the financial summary, one of the areas I wanted to show you is our median number. We actually saw our median farm, so that midpoint of those 2,000 plus farms was actually at a relatively decent level for net farm income. But I did want to kind of highlight as well that we also have seen the farms that have actually started to increase net worth, gain some equity, and build back some of the equity that was lost in the previous 5 or 6 years by a lot of the farms in Minnesota. You can see our term debt coverage ratio, kind of the green standard is above 1.75. And you can see that really we're kind of the last 2 years we've been above that. And obviously the average, because of 2 strong years, is above that as well. But we had 2 years prior to that where we were in either the red area of concern or kind of that midpoint of cautionary area. And then our percentage of working capital to gross has continued to grow the last 2 years. So that's kind of that buffer zone for our farmers to have. If they were to have a down year, that's the amount of either crop on hand, livestock inventory, feed inventory. It could be cash on hand itself. Could be prepaids that they have as well that help kind of buffer if they were to have a shortfall in the next year. The financial standard summaries, we really see a lot of strong numbers here for our farms. Probably the biggest thing I wanted to mention, this is kind of one of my favorite numbers, is capital debt repayment margin. To me, this is the money that's left after everything. The one difference between that and that previous chart on what is net farm income used for is there's some differences on accrual adjustments for interest actually paid versus accrued interest. And then you have an actual adjustments for things like income taxes paid versus accrued interest or estimated interest going forward, or excuse me, income taxes going forward. We can see that we saw a relatively good increase in a lot of these ratios. One of the other ones that a lot of people like to look at is this operating expense ratio at 67.0%. That's relatively strong. Anything under 70% is considered a strong number. And we're not quite in the green culture like we were in 2012. And realistically, this is very similar in our return to farm assets is comparable to that as well. On our financial summary here, average net farm income, again, we see that across all different parts of the state. So we kind of divide the state into the northern part, the southern part, and then the Red River Valley. And you can see that all of them had strong net farm income. They have strong return on assets, return to equity. If we look a little bit further down, as we get down here, we see some total crop acres and machinery crop values in this chart that shows you kind of where the averages lie for each of those groups. And then you can see some of the additional liquid and solvency measures as well. The next two pages are a little bit different way to look at things. So this is dividing it by the type of farm. So we take where the 70% of all your gross revenue comes from, puts you into a category. So did it come just from crops? Did it come from just livestock sales? So hogs, beef, dairy. Did it come from a combination of a couple of those? So like crops and dairy, crops and hog, crops and beef. Or if you don't fit into those categories and none of those allow you to get 70% of receipts, you get kind of lumped into what we call the other category. But you can see realistically across all different types of farms, we show a positive net farm income, even a positive median farm income, which for the last few years, usually sometimes we have a negative number, at least somewhere in there. And so most of our farms, obviously we know there's farms out there that are still struggling, but on average, most of our farms did show some good profitability and some good growth there. And you can see those, true debt coverage numbers are all kind of in the green, even in some of our livestock areas, which I know have struggled in some of that. And then we'll see what 22 brings. We have some lower prices heading into that. We did have some support levels with some government programs that aided with that, that help buffer that. So we'll see what happens with 2022 with that. And again, you can see those charts on net farm income and liquidity and solvency. And the final page is a new adjusted page this year to kind of do a comparison of years farming between what we would define as beginning farmers or farmers less than 10 years, kind of that mid-career, that 11 to 30-year farmer, and then kind of those farmers that have been what we call our seasoned farmers of more than 30 years of farming. And you can see that, we're a few more in that season category. And obviously, we have a pretty equal number between mid-career and early career. And so these are farms that have submitted an analysis. One of the things you'll notice that there are some strengths for our beginning farmers. Obviously, they have a stronger return on assets, return on equity, and they have, relatively a little bit better than the mid-career on that working capital or gross. Part of that is due to the fact they're usually a little bit smaller operations. They usually rely on working with somebody else to provide some of the assets needed to farm, so equipment. And so they don't have as much equipment, so a return on assets going to be higher when you don't have as many assets on the balance sheet. The downside of that is when we look at things like net worth and farm debt to asset, it's going to be a little bit higher because they don't have as much assets. So even if they have the same amount of debt as a seasoned farmer or mid-career farmer, they're going to have some of those challenges of if things do turn for the worse, they don't have the equity in their farm to really kind of support themselves in tougher times. And we've seen that in the previous probably 10 years when we did have some tougher times, it was more difficult for that. So we look at all of that information, total liabilities, you can see it's lower, but realistically we see that because we have a lot less assets as well. And so one of the things that is concerning is, if things were to downturn is they don't have that buffer system like somebody as a mid-career farmer or a seasoned farmer would have. And so you can kind of see the different, we see like the median net farm income, the net worth is a lot lower. That's that buffer level. But they're also stronger in some of these things of like return on assets, but they also have higher debt. So there's some good comparisons for that. So all of this information is on the Ag-Centric website under the farm reports. You'll find additional reports there. We have a state dairy sort. We have a state crop sort. We also have reports from around the state. We have the Red River Valley report, the Northern Minnesota report, the Southern Minnesota report, along with some other regional reports as well. So I want to thank you for taking the time to watch this video. And if you have any questions, please feel free to contact us through Ag-Centric. Thank you.